Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right, we are back with another episode of the Real Estate Investing Club. Today is a good day because this is a twofer. Not often do we have two people on one podcast, which means 2 times the wisdom, 2 times the fun. So it's going to be a good one. We have Jen and Stacy with us from over there in Florida with the Remote Multifamily Investing Academy. Tons of multifamily experience. We love multifamily guys, so I'm sure this will be a good one. Guys and gals, I apologize. Jen, Stacy, thank you guys very much for hopping on the show.
Yeah, thanks for having us. Thank you. It's awesome to be here, Gabe.
Absolutely. It's always a nice, dance that we play when we have multiple people on the podcast trying to figure out who talks. So I'm sure we'll figure it out. All right. So I told you guys before we hop on here, we like to start with stories. I'm sure you guys have a good one. So why don't we go back to the very beginning of your story? How'd you get started in real estate?
Sure. Well, we both started just over 20 years ago, but on separate paths. So when I got started, I lived in Northern California. It was expensive and pretty competitive when I started. And so I had, I paid for an education, went and learned how to do it. And I found it nearly impossible to implement where my home market was. I didn't have a lot of capital. And so I ended up learning about remote investing. And that was, so all the real estate investing I've done has always been remote because I just couldn't get any, groundwork going.
Man. I get
when
it.
I was,
I'm in Seattle, so it's like, who has $10 million to buy a single house?
Right. Precisely. Right. Exactly. So, 20 years is obviously a long time. So it started with single family homes like most people do, then doing, duplexes to fourplexes. And I've done every different strategy. Multifamily's always been a part of it. In the last several years, we've just really focused our efforts on solely multifamily. So that's kind of our I'll let Jen tell her story, but
I started around the same time, about 2002, with single family homes, flipping, buy and hold, getting into plexes. And in 2015 is when I met Stacy and found out that she was doing apartments joint venture.
Were you also in Cali doing this?
Yeah, I was in Cali. And, you put all that money, so much capital for very little return. And like my first flip took 7 months and I made a whopping $1,500 profit. And I was like, I'm over this, this is not fun.
Good on you for keeping going after that. That would just take the wind out of my sails.
Yeah, the DIY approach of like scraping popcorn off the ceiling, that whole, I was really ambitious in my 20s. Got my dad and my brother on board with it, and then just realizing, 7 months for $1,500, that's not very lucrative. I'm not okay with that. So, but by the time I met Stacy, I had dialed in a little bit of an approach, but I really wanted to get into apartments, and she was already doing it. I already had a course on how to teach people how to do it. So I was like, hey, let's go on more dates and figure that out, how I can step into that world. And from there, we then realized, I was like, man, I really want to go. They kept talking about acquisition fees. I was like, I really want to go learn how to do that. And so we went into commercial training, syndications, and really just went to implement and realized it's not as easy as it seems. So I asked the question, you're teaching people how to do this with joint venture. Like, is there a way we can underwrite it and get those acquisition fees and disposition fees? Like, how can we make that happen? And that's really when everything sort of shifted for us because, well, she's a freak in the spreadsheets and made it happen. So that's literally like what got us all the way up to 2016 and just went for it. Started doing the joint venture approach, underwriting for acquisition fees, disposition fees, and dialed that process in, and then started scaling into syndication. And now we do both, obviously.
Interesting. You're the first person that's been on here that's mentioned that as its own unique strategy. So I want to know more. So you guys you kind of made a mini business out of underwriting properties for people and then bringing it to a JV partner who has the capital, who has the experience. And then they run the deal. Obviously, this isn't what you're doing right now, but this is, that was a portion of your career trajectory, was finding the deals, underwriting them, and then partnering with somebody to close it.
Yeah, just like we had already been doing. The main difference was that when we were underwriting it, we just built in, like, is there enough room? Is there enough profit in this deal to be able to take an acquisition fee and still have the returns be compelling enough to attract a partner into the deal? So it wasn't really, it's not that our operations were any different. It's just, can we build that number, and making offers that would allow us to build that in. And it just made everything more profitable, because obviously getting a lump of cash in the beginning allowed us to just do more faster.
And I think that one of the things that benefited us is that our method of getting deals and filling our pipeline up until then was really about establishing relationships with brokers. So by the time we were getting off-market deals from brokers, those deals, they were a little bit sweeter.
Yeah.
So there was more spread.
Especially in multifamily. It's really difficult to find, super, super sexy deals on market.
Exactly.
There's been a lot of people that have turned those deals down once they're on the market.
Yeah. And I don't think, when you said you'd never heard anyone talk about it before, I don't think I've ever even heard anyone doing it. And we had an event a couple months ago in November, and there's a commercial broker who's been doing commercial broker for like 20 years. And I was just, teaching our students about it. And she was like, wait, hold up. You could do that? Oh my God, I can't. And she was just like mortified at how much money in her mind she had left on the table, because it just didn't, that it was a syndication thing. That's the only time we'd ever heard of it, was when we went to training on how to syndicate deals.
Yeah.
But syndication is just not as not as easy as it sounded in the classroom.
Yeah.
But yeah, I don't know that anyone does it. Our students do it, obviously, because we've been teaching them, but
I don't know if anyone.
I don't
else
know that I've ever heard anyone talk about it.
Methodology, for sure.
Yeah.
And I think the only reason why it worked is because of how we were building a pipeline of deals. Because if somebody went to go do this with a market, it's something that's listed, they're not going to find the spread to fit that fee in there. So you've got to be able to have that relationship and start getting the off-market deals. If you are, then there's a way to do it.
Yeah.
I've never heard of anyone.
So are you guys, when you back when you were just doing this, were you going in with an equity position in the property, or were you just taking the acquisition fee?
Oh, no. It was literally the exact same way we would do any property. It's just that we also had an acquisition fee. So in that case, we are the operator. Like those ones, we're operating the deal. Obviously, our joint venture partner or partners have to have some active role, but we're carrying the majority of the load because we're the expert. We're the ones who know how to do it. They want to be involved, but mostly their role was, the capital side of it. So it was everything we were already doing. Just now we were
adding the acquisition,
getting paid a chunk of money in the beginning, and being able to roll that into more properties was nice.
Absolutely.
Yeah, I've done that a few times, but it is, when you get started on the commercial side, not on the single family side, but on the commercial side, not a lot of people talk about that. Adding an acquisition fee is a thing. And so you don't really realize that's an option until somebody tells you about it. And the person that tells you about it is not going to be the person you're partnering with.
No, right.
Right.
That's true. Exactly. That's true. Yeah.
Cool. Well, I'm glad you guys found that. And have you done syndication since then as your own GP or?
Yeah. We just closed on a syndication 5 weeks ago.
Yeah.
And we just finished the raise 3 days ago.
Yep.
We raised enough to close it, and then, finished the raise after the New Year. But yeah, we closed on a syndication on December 27th, and then on a joint venture on January 8th. So we do both. It just depends on what comes up,
what works,
certain deals,
who has the money available, all that kind of stuff.
Yeah, exactly. Certain deals are just too big. They're too big to joint venture. No matter how bad we want to do a joint venture, that just requires too much capital.
Nobody has $2 million just in the bank ready to be put in.
Exactly. So it just depends on really the deal. And we'll just, the syndicate or joint venture is just really the financing structure of, depending on how big the raise is.
Yeah. Yeah. And you've mentioned a few times you didn't realize how hard syndications were. And I had that same thing. Like I had a deal that was just a slam dunk fail because it was, first a syndication attempt. Yeah. I didn't realize how hard it was to raise money. And so when you kind of walk me through, you've had successes, you've crossed the threshold, I guess, of having a syndication go through. What were the I guess kind of the aha moments or the light bulbs that you had that kind of allowed you to make that a success and actually get one done?
I think the biggest, I'm going to let you answer, but I think the biggest aha for me was realizing that we can do syndication, but start with the smaller property for syndication, because a smaller purchase price, it's a smaller raise. And when it's a smaller raise, it's like, okay, I can do this. It's more bite-sized.
Your anxiety is like,
actually do, instead of this huge thing. So for me, I think it was just that shift, realizing, oh, okay, if we can syndicate smaller deals, anything like 35 to 98, 100 units, and do smaller raises, then we get momentum. And now we've got those on the books.
You have
and then
successes, you can point people like, hey, check it out. I did this syndication. It's
absolutely.
a success. This is the return my investors have.
Yeah, you could book a win easier if you start with a smaller building to syndicate first. Versus, in the seminar, they were telling us, oh yeah, we can go for a 200 unit, get the biggest ones you can. And so of course my big old eyes were like, oh yes, I want to go make all the $800,000 acquisition fees. That'll be great.
Yeah,
I'll never have to do one again, but no, that was not facts.com.
Right.
Yeah.
Yeah. And syndications, it always seemed like a very daunting word, I guess. It's just because it sounds so fancy. But it's not that complicated. You just get a lawyer to draw up the syndication docs, you get people to send the money in, and it's not something that should be, I feel like it's something that people should go to earlier in their career. For properties, you can even do it for $1 million property, like something relatively small. Probably you don't necessarily want to, because you can probably find an individual, a JV, to go out and finish that deal. But I do agree that it's something that you should do smaller deals, just get it done. So you have it in your success in your back pocket, and you can take it going forward.
One of the things that we've been talking to our students about, or teaching since we did the academy or started it, was, look, when you're getting started. So for anyone out there who's listening and you're wanting to get started, and it's like, man, there's so much to learn. I always tell people, look, it's fine. Like, start with a little 10-unit building. It's not like you're going to retire from it, but a 10-unit building is not going to cost a lot of money, especially if you do it in the Midwest. And you can definitely do that as a joint venture. You're definitely not syndicating anything that's 10 units. And the amount that you learn from that first deal is incredible. Yeah. Like there's a pretty big learning curve in apartments, and and going through that learning curve on a smaller property that allows you to just really understand and learn the business and become a much better operator is really going to serve you long term. You finish that first deal, and now you have experience and confidence, because now you're like, oh, I actually can do it. And now you have credibility. And then we tell, like, stair step, and then go to a 20 or 25 unit, take that one down, and then go up. So we're always talking about, do a stair stepped approach. And our students are usually by deal 4. If they're wanting to go, they're usually doing 3 deals as joint ventures, like just bigger and bigger and bigger. And then they get it to a point where it's just too much of a raise. Mm-hmm. And then, like Jen said, like, just doing a smaller raise syndication is a lot easier to take across the finish line. And I think that's the big thing that people don't realize when they're new. Like, you really need to start with a database of investors, because that's the scary thing when you're doing a 506B, which is what you do as a new person. Usually, you're limited to only who you already know. So you better have, like, your Rolodex better be deep, or you better partner up with somebody who can capital raise with you, who's got a deep Rolodex.
Absolutely.
But a smaller deal has a little bit smaller chance of failing, because it's just more doable. And then you do that one. One of the other things I was thinking when Jen was saying that was, when you've done that first syndication, even the investors that are in that syndication, they frequently have a lot more capital than what they put in, especially if it's their first deal with you. They're like, okay, I'll put in the minimum. Yeah. I'll put in just the 100,000 or just the 50,000 and let me see. Yeah. So one of the things that we've found is, as we continue to do more deals, it's oftentimes the same investors. Even if we're not out of the deal that they came into first, we're still within the 5 or 7 year window of the exit strategy. They're putting more money into our other deals. So starting with that, a smaller one, and just starting to build the credibility with your investors and let them get comfortable is going to open up more money from those same people, even on your other deals. So there's a lot of reasons to just stair step it. And it doesn't take very long before you're at 100 unit and then up properties. Yeah. Especially if you take that approach.
Yeah. I couldn't agree with you more. I always had, I just disagree with I think it's one of the big guys like Grant Cardone or something, who says, start at 100, screw the smaller properties. I'm like, if I had started at 100, I would be shitting my pants. Like, it would not be a pretty thing.
Think
But
of how much you learn on
yeah,
each deal. Like, can you imagine making the newbie mistakes on 100 units? Like,
right.
that's insane. Those can be 7-figure mistakes.
Yeah. Yep.
That's the other reason I'm like, look, just learn it. You're going to learn things. You're going to figure out the better way to do things. You're going to probably make some mistakes that you can not take to the bigger deals.
Yeah.
But yeah, I hate when people say that. Oh, it's the same amount of work in theory, but holy cow, like
Yeah.
start
You don't
with
want to make a
something
mistake and then
manageable,
and then have cost people hundreds of thousands of dollars.
right?
I will say
Yeah.
on the other side of that, and I've mentioned this a few times on the podcast. When I first got started, in buy and self storage, I wanted to buy small because I wanted to make small mistakes. What I didn't realize, and the reason that I wish that I had gone a little bit bigger than I had started, was on small properties. Small mistakes can easily eat out all of your profits, all of your cash flow. And so if you don't get the underwriting correct, then you're kind of screwed, because you don't have, if you're
There's
cash flowing a
nowhere to
couple
make it
thousand a
up.
month, there's there's nothing there. You can't make mistakes.
That's
So I
absolutely
love the message of start small. I would just put in there, start a little bit bigger than like nothing. Get a medium sized property. I feel like is a good place to start.
Yeah, that's fair.
I'm a fan of the 10 unit.
10 unit,
least
yeah,
10 to 15 units to start. Yeah.
it's a good size. All right, man, we're crushing this time. We do have to move on, but before we do, I want to ask. You've already mentioned remote investing. Your academy, is it called Remote Multifamily Investing? So I want to talk about the concept of remote investing, especially for people who are in those coastal cities, Seattle, Las Vegas, or sorry, not Las Vegas, Los Angeles, New York, all those places where purchase prices are through the roof. You can't afford to buy a house in your own area. Then you got to look somewhere else. You got to do that remote investing. So tell us, what is your guys' tricks? What are the suggestions that you give people who want to get started investing outside of where they actually live?
You want me to take this?
Yeah.
Okay. So I think
I learned it from her. So yes, take it.
I think the biggest thing, just to could lay a foundation, is a lot of people get hung up on that, like remote, like how am I going to know what's going on? How am I going to see it? And all the things, right? Or how am I going to find contractors, or how am I going to find a property manager if I'm not there? And so the very first thing when people are like, I'm intrigued because I live in California and I can't invest here. So I want to do it, but I just don't understand how you possibly would do that. I'm like, all right, well, so you're sitting at your desk or you're sitting on your couch, and all of a sudden you start having water drip on your face, and you're like, oh shoot, there's a leak in my roof. Like, what are you going to do? We'll go out on your front porch and start screaming up and down the street, I need a roofer. I need a roofer. Like, no, you're going to open up your computer and you're going to Google, or, look at any of the number of sites out there. You're going to look for a roofer online, and then you're going to get on the phone and you're going to talk to the roofer, and you're not going to ever probably meet the roofer until they're doing the repair. And it's the same thing with remote. So it's like when you start to realize, oh, that people operate remotely anyway.
Yeah.
So the main thing is just understanding, it's just a mindset shift. But that's what we do when we identify a market and we're starting to get deal flow. We will build a team in that market, and we find them the same way we find local vendors where we live for our personal residents. We go online, we talk to them, we vet them, we get all of their credentials before we do it. And when there's work being done, we always have like third party checks and balances, which you tend to not do when you're doing it locally, because I think we put too much emphasis on like what we can see or what we know, and like, what do we really know?
I love this analogy, because it's exactly how she had to explain it to me back in 2015. I was like, what? How am I going to know that they did the right thing? Like, what are you talking about? That's insane.
Yeah.
And the analogy, it just cracks me up every time, because I was like, how am I going to look and see that they did it right? And she was like, are you a licensed contractor? And I was like, no. She's like, well, how do you know what you're looking for? I don't know, but
That's a good point.
I just want to see it, Yeah. So it's funny because it's true. And then you realize that I was actually losing time by being there, and it wasn't scalable.
Yep.
And so once that shifted, it opens up everything, because I would still be making $1,500 every 7 months if I still was trying to do it there in California. So it was just a mindset shift for sure.
Yeah. And even the properties that I do own, that I could go to, that are local to me, I go to them maybe like once or twice a year, it's like I don't necessarily need to be there anyways, and so it doesn't really matter. But yeah, I like the analogy of like we do remote investing, even if your house is like you're living in your house, or it's like two blocks away from you. You're doing remote investing already because you're just Googling, you're just calling, and sometimes I'll even have people just do video calls.
Yeah,
with me
exactly.
when they
That's
finish a
how we do it.
project. And so
Yeah.
That's exactly it. It's really mostly a mindset shift.
Yeah.
And recognizing you're not really, when you're local, you're not really seeing it anyway, not at least not through a lens that is qualified to see anything out of it that's relevant. Like you need to have an inspector or like somebody third party that's actually an expert in that area. They're the ones who need to have eyes on it, not you.
Yep.
So true.
Yep. Cool. Well, we've run down the clock, so it's time to jump into the quick question round. Are you ready?
Yeah.
Sure.
Let's do it. It starts with education. Could be any form, could be books, could be movies, could be Netflix shows, YouTube channels, whatever. I just need 2 recommendations, one for general life wisdom and then one for real estate.
Ooh. General life wisdom.
Yep.
I would have to say, oh my God. God, I have so many. It's hard to pick. It's hard to pick. Yeah. Let me look around at a book. I think that you go first. You got anything for real estate?
Like where people would go to just learn about like real estate?
Yeah, just any form of education that had an impact on you.
That had an impact on me.
Yeah, you go ahead.
Oh, you know what? The education that had the most impact on me, frankly, was the one I took in 2003 when I spent $40,000 and learned how to do, in theory, every kind of real estate, but at a very macro level. And so when it came time to implement, it was missing 90% of the information, which honestly is what sparked. I was so frustrated at the time. And I lost so much money on every single lesson because there was no education on it, even though I paid $40,000 for it. That's what sparked in me a passion for making sure other people do not have to go through that. And so that's why it was the most impactful, because it was crappy and it really set me up for what I feel like I'm meant to do.
Yeah, for sure.
Is lift other people up so they don't have to go through that pain and then and quit, because most people would quit.
Yep.
For me, the most impactful that I did was NLP. I am a master practitioner of NLP, hypnotherapy, MER, basically a bunch of mindset stuff to get you into peak performance, and also neuro-associative conditioning, so that I can get myself into peak performance mentally, because 90% of this business is upstairs, all in your mind. And it really taught me over the years how to not only just get myself conditioned to always perform, but help others. So that's something that I love to do. And one of the best books that helps from a business perspective as we're going through and building a multifamily business is the book called Traction.
Oh, yeah.
A great book, great way to look at all of the things, all the pieces of your business and have a plan. And I think one of the best things that I could probably suggest to somebody is there's this old school thought process of make a 5-year plan or a 3-year business plan. And stuff changes so much. And now, especially with AI out there, we plan in 100-day increments. So there's a journal out there and it's called 100-day journal. And it's John Lee Dumas. We plan in 100-day. Yeah. It's like, it's the step-by-step for us. Like, okay, I'm only going to plan in 100 days. And on day 90, I'm like celebrating. Yay. Now what's the next 100 days going to look like as I execute these last 10? And that has been life-changing for us. It gets that momentum going. So those are my 2.
That's cool. It's cool you mentioned that. It threw me back. That John Lee Dumas, his podcast, that was the guy that I remember. It was like I did my first flip in 2014. It was like 2012 that I was just listening to all his episodes. And I bought that 100-day journal. I never used it, but I did buy that one. And I remember
it's good stuff.
It's really good.
We go through 4 a year at least. But yeah, the Entrepreneur on Fire, his podcast there too is pretty good.
Yeah,
for sure. All right, next question. This is for your younger self. So let's go back to the Jen and Stacy who had no experience in real estate. They're living in California, looking at those house prices, thinking, how am I ever going to buy one of these? Go back to them, look them in the eye, give them one piece of advice moving forward.
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Look for Stacy
Stop it.
so you can learn remote. That's what I would have
Yeah.
done. Yeah.
I like it.
I think that I would tell myself, don't let your ego control the fact that you think you can control things. Like control is a perceived thing. And my ego got in the way of me that I had to do it all on my own. And I would have scaled more if I would have embraced a team and embraced things that were a little bit outside of my comfort zone, but more scalable. That's what I would probably go back and tell myself.
Yeah, that's really good.
That and stop buying rims for your car because that doesn't make you cool. Assets make you cool. I would definitely say that too.
Luckily, I never had that affliction, but I could see how that could drain some dollars.
Yeah, stop flipping houses to buy rims for your car. That's dumb. You know?
Oh my gosh. I think for me, I was so enthusiastic when I was new. I wanted to do everything. I wanted to do everything right now, right away. And I did, which, that was probably part of why there was a lot of mistakes in addition to not having the right education. But I think I would have told myself, like, slow down a little bit and go lower leverage. I think that was one of the biggest things that, hit me in 2008 was because when I started, you could get 90% loans on rental property. So I was like, well, why would I get anything lower if I can get 90%? But then when you get squeezed or when the economy changes and your tenants have problems and they can't pay, you just don't have enough room to maneuver. And it's hard. It just makes it hard. So I think that's the biggest thing I would have gone back is like, one, slow down a little bit, calm down. You don't have to do every strategy within the first 3 months. And also just, do fewer deals, but with lower leverage so that, if you hit a challenging time, you can get through it.
Yeah. Yeah. Those are all good pieces of advice. The lower leverage thing, it makes a lot of sense. So often I want as much debt as possible, especially when I'm underwriting really good deals. But
of course,
it is better to have, to put more, especially when you're beginning, to put more money into the deal. Because if something does go wrong, it is horrible to have a capital call or just to even reach into your own wallet and have to pull more money out. So good advice. All right. Next question is about the US. This is a good one for you guys because you're all about remote investing. So the United States is a big place. There are so many great metros out there. I want one metro from each of you. Have to be different metros. You can't choose the same one. So a single metro that you're most excited about investing in today.
For me, it would have to be Phoenix, Arizona. And the reason why is, 4 years ago, it was one that it didn't make sense to enter without floating rate debt. And the 2008 experience that I had, I'll never do floating rate debt again. Mm-hmm. And now that we've got 2,500 multifamily properties that are facing a foreclosure wall and knowing that those are all in, Florida, Houston, or Texas and Phoenix, Arizona, it's not because the market is bad or shifted. It's just based on the bad financing. And there's going to be a lot of opportunity there. And I would like to be the one that could meet those folks and help them get out of that situation. And, but I know that a lot of them are a little too far gone and they might go to foreclosure. So, but for me, it's that Phoenix market. I lived in that market for 9 years from the 90s to the early 2000s. And then I lived there again in 2011. I know the market really well. I'm borderline obsessed with it, but I've never invested in it.
Yeah.
And I already know which market Stacy's going to say, because it's the one we're already in. And I'm also in love with that one.
Indianapolis.
Yeah.
Yeah. I love Indianapolis. We've been investing in Indy since
2017.
Yeah. 2017. Yeah. And, it's hard because when everything went up, prices went up there a lot, which was cool from an equity standpoint, but it made a lot of the numbers not work. But I think that's our favorite or that's my favorite market. I know that's one of Jen's favorite markets. And really it has everything to do with it's just landlord friendly.
Yeah.
Like the numbers work well. It's in the Midwest and it's landlord friendly. It's everything we
I love
everything
it.
we
I love
like.
Indiana. I love
Yeah, Indiana is our favorite state for investing, and Indianapolis Metro is that's our place.
It's funny you say that. We just bought a self-storage facility in Indianapolis in Lawrence, which is kind of northeast Indianapolis.
Okay,
and, I really like the metro, and so we just recently decided to really focus in on Indy. I like all the metrics, and so
good choice.
Yeah, it's awesome. Nobody else has said Indianapolis, and so 450 episodes. No love for Indy until you guys came on. So
my gosh, that's funny. I love Indianapolis.
We went to the pole race. Was it last
pole day?
Yeah, pole day. It was
2022.
Yeah. And we got to ride around on bicycles and go look at least 12 of the properties we have there.
Because they were right by the hotel.
Yeah, it was so much fun.
I was like, I think we own property in this area. Like put it on the map. I'm like, oh my God, we are so close. We should, not that we're going to go in it because they don't, the tenants don't know us.
So weird riding in front
riding our bikes.
Hey, these ladies.
That was fun.
That's cool. All right, moving us on. This next question is about finding the deal. It all starts with getting in contact with the seller and writing up that purchase agreement. So what is your favorite way to generate leads and find new deals?
Well, for us, our system is to contact brokers and build relationships. It's a relationship business for us. And but my favorite way now is we started our academy back in 2019 and we trained hundreds of students to find the deals, and now they're bringing them to us. So we have a lot of students that have been with us for three years or more. We don't really have to go find deals anymore because we taught them and we sort of cloned ourselves. So that is hands down my favorite way to find a deal, is that our student brought us one and we do the deal with them as a partner.
Perfect. I love it. All right. Second to last question is about lessons. Not every deal goes the way that we expect it. Sometimes a wrench is thrown into the mix and we get the opportunity to learn a lesson. So what was a deal that went a little sideways for you guys? And what was the lesson you pulled from it?
I have one. If you
go ahead. I was like, well, which one? Go ahead.
I lost $80,000 in a day. In one day.
That hurts.
It was painful. And the lesson was get an inspection. Sorry, you're gonna have to beep that out. Sorry.
Yep. That'll do
Sorry. The lesson was get an inspection because I overlooked it. I thought I didn't need it. It didn't seem like I would. And lo and behold, it was actually in Washington. So it was Post and Peer Foundation that got me. And I knew nothing about Post and Peer Foundation. And it was the first time I was in that market. It was the first asset that I was getting in that market. And the strategy has always been, when you're going into a new market, get one asset and test it before you go deeper. So needless to say, I'm not in Washington anymore.
Oh,
The Post and Peer Foundation really got me. And, I had to get a structural engineer involved. And it turned out that it was going to be like, you have to jack the whole house up, re-pour the concrete. And it was a whole mess. It was like $26,000 was the cheapest bid I could get. And I wasn't even confident that they would do the work right. So I ended up selling it as is and taking an $80,000 loss. And I have never not got an inspection since.
On behalf of everyone here in Washington State, we're sorry you had to go through that. But yeah, that's a good lesson to get your inspection every single time, no matter what. No matter if you think you know everything about the property, get an inspection. It's worth it.
Yeah, that ego there I still wasn't over it yet.
Yep. All right. And let's see. Next, I always lose my spot at this time because I have a list on the right side. And I never keep track of where we are. So, that was the second to last question. Now we're on to the last one. And this is the one that we've all been waiting for. You guys have given us so much to think about. I'm sure people want to reach out, get in contact with you. What is the best way for them to reach out? And then tell listeners a little bit more about Remote Multifamily Investing Academy, how they can get involved, what they can expect, all that kind of stuff.
Sure. Okay. So if you can go to warriorsofwealth.com, and at warriorsofwealth.com, we have curated a playlist of our best trainings on our specific blueprint for how we acquire multifamily, how we manage our portfolio, all of those things. As you're in there watching it at warriorsofwealth.com, there will be a button there to click if you want to explore the academy. And at the academy, we really just take active investors that want to know how to get into it, and we teach them how to start with joint venture first and stair step into syndication. Most of our students are with us for 3 years or more. The first year we're watching them to see, are they following our system? Are they implementing? How do they handle problems? How do they, if they make a mistake, how do they handle that? Just how do they conduct themselves? And at the end of that first year, we make them an offer to come in for years 2 and 3, in which they would be with us for life at that point. And we just help them continue to grow in syndication. By the time they're in year 3, they're there for life. They don't ever pay tuition again. And now they're doing deals with us. We symbolize it by, at our events, we put their name on the back of a chair. They get front row seating. And the only thing we ask of them, and in exchange for no tuition ever again, is to turn around and help all of the new people that come in and help them understand so that they can shortcut their learning curve and get into results faster. And it's just a really beautiful system. Some folks have accused us of being cult leaders. We embrace that because we've really created.
It seems like a cult sometimes.
It does. It seems like a cult.
It's so awesome though.
But we have a community of students, hundreds of students. They all love each other. We love them. They're going from zero real estate to $35 million real estate. Like it's awesome to be a part of it. And it's really no other way to explain it other than to experience it. But if that's something that you want to explore, definitely click the book a call button. Otherwise, if you feel like you can look at that list and go through all those trainings and start implementing, like it's all there, for everybody that needs a roadmap.
Perfect. So that is warriorsofwealth.com. I will put that link in the show notes. So if you guys want to get involved, just click the little more in the description. It'll pull down that full description. And in there, you can find that link. But it's also really easy to remember, just warriorsofwealth.com. So awesome. Jen, Stacy, it has been an absolute pleasure. Thank you guys very much for hopping on the show.
Thanks for having us, Gabe.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe, at realestateinvestingclub.com. If you want to support us, just give us a like, subscribe, share, all that jazz. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.
All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.